Good afternoon, everybody. Welcome to our Trading Index Options webcast. I'm Connie Hill. Happy to be with you here today. Over the past few weeks, we've been exploring maybe adding some different rules to our systematic approach, or at least the one system we've really delved into. We're going to try to finalize some more details with that plan so that we can do some forward testing with it. Okay. I know some of you have been doing some back testing along with me, and so as we get to that point, I want you to share maybe some insights or comments or maybe some questions that you have as you've been doing that. I hope you're following us on X. I'm Connie Hill CS. We have the pleasure of having Cameron May in our chat as well, and he's put his handle in there. He is Cameron May CS. We'll post educational content throughout the week, things that we notice in the markets, maybe with some charts. We will share that information with you. We like to do that. Happy to see so many familiar faces here. And if you are new, happy that you've joined us here as well. Now, if you have questions, put them in the chat. I'll be trying to pay attention to the chat. I shouldn't say trying. I will be paying attention to the chat. Cameron will have his eye on it. And so as you have those questions, let us know. He might have to catch some questions I can't quite get to. All right, but we do want to hear your questions. If you're listening to this on the recording, like many of you do, when you have questions, put it in the comments section of YouTube. We go back and review those so you can get your questions answered quickly as well. See Richard in here. Richard is a frequent contributor in terms of the comments that are left. He sets a great example for you all. No, yeah, you don't need to make a comment, but if you had questions, please do so. Right, let's go through our disclosures. Got a couple of announcements, and then we'll get into our agenda here today. What we talk about is intended for educational and informational purposes only. Don't consider it a recommendation. Past performance is no guarantee of future result. For the sake of simplicity in this presentation, we really won't take commissions and other transaction fees into consideration, but you would want to make sure that you are considering that as you're planning out your trades. Equity and index options carry a high level of risk and are not suitable for all investors. We will be working with typically European style options with the SPX and XSP, and they do not assign early, which is one of the nice things about them. However, most American style options can assign early. We'll be using the Paper Money platform. It is for educational purposes only, but I think it's a great tool to use as you're doing your own testing. When we're talking about probabilities, keep in mind they're theoretical in nature and never guaranteed. As we use the Paper Money software application, there's a couple of things that it doesn't do that a live market can do. And one thing it doesn't do is assign early. In this class, typically, because we're not working with American style option, that isn't a concern. However, I do want you to be aware of it for pretty much everything else that you're working with in trading. All right, a couple of announcements. Number one, tomorrow evening from 7 to 8 o'clock, we'll have the 2026 mid-year market lookout. This is an event we hold twice a week, or twice a year, only twice a year. And we have presenters that are ones that are keeping track of things kind of in a macro picture, different asset classes. And so we get to hear from them, see what their thoughts are as far as, hey, what's the last part of 2026? What do they think maybe things could look like? So you could do that off of the YouTube channel, just like typical. I am going to throw a link in the chat here, and this link will allow you to register for the event. All right. The other one, oh, I accidentally hid this. I didn't want to hide that. I wanted to show you what our upcoming events are going to be specific to workshops and market drive events. So Chicago will be there in about what? That's going to be about 3 or 4 weeks. 3.5 weeks we'll be in Chicago. Then 2 weeks after that, it will be a market drive in Dallas. Market drives are one-day events. Typically, they're just on a Saturday. And it's a little bit different in that we're talking a lot about current market conditions as opposed to drilling into specific option strategies and technical analysis principles, which is what the workshops focus on. And then we'll be in Orlando, August 7th and 8th. So if you can get there, you live close by there, make sure to show your face. You will appreciate being there. It's strictly educational. It's free to you. And I'm going to tell you, there is not a sales pitch. Okay, and a lot of events, you're probably like, "Ooh, is it going to be a sales pitch?" No, not with our educational products. We don't really do that. All right. All right. Oh, Charles is expecting a dryer delivery. Hopefully it'll come before then. Yes, hopefully it will. It will be recorded as well. So if you have to come back and look at it, not a problem. All right. We have been experimenting with some different rules in our SPX weekly system that we trade. We're going to spend some time on that. Before we do, I want to head over and take a look at the SPX. I'm going to leave the lines up here that we use for our 14 to 7 day trading. I'm going to call it a system or kind of rules that we're following. But I do want to bring something up additional here. The blue line is my 20 period moving average. The red line is a 50 period, so a little bit faster with the 20, intermediate 50. Then the screen line down here is the 200-day moving average. Got a MACD here on the bottom and the enhanced market forecast on the screen. And I've shown you about the market forecast study previously, and I was going to have that link sitting right here to give you. And I am not, it's not jumping out at me at the moment. Nope, that's not it. Let me find it. The one thing I'll tell you about it while I'm looking for it. Here we go. Market forecast enhanced is what it is called. And there is a market forecast study just in your regular studies. Everybody has access to it. This particular one, I call it enhanced because it does some shading for us. We've got this green line, blue line, red line. Down here in the market forecast, they represent different time frames, intermediate, shorter term, and kind of momentum type time frames. Okay. We're going to change our chart here for a minute. I want to talk a little bit about seasonality and using it kind of as an idea as far as what maybe can we expect from the markets if they follow traditional patterns. Market doesn't always follow the same pattern every year, right? This year, if you would have used the adage sell in May and go away, meaning sell all your stock and go away in May and have a good time because the market probably won't do that much, probably could have been unsatisfying to you because month of May did really nicely. I'm going to change this chart here. We're going to come down to our style. And then we're going to change chart mode. And we're going to come down, and typically we just have it on standard here. I'm going to change it to seasonality. And with this seasonality, it's essentially a style here. We have a couple of things going on. This blue line is our year-to-date line. It is just kind of a line chart, right? Connecting the closing prices, so we're seeing this line. Then under the seasonality, the default period of time here is 5 years, okay? So it's showing us essentially what the average has been over the last 5 years on the SPX. It doesn't mean that they do the same thing every year, but it's interesting to note, okay, what it is. So we're sitting here today on June 24th. And I'm going to put a little line in here for where we were last week on the 14th. And let's just get, I want that drawing tool, and I'm just going to draw on the 17th right there. I'm going to draw a line for where we were last week, and then I'm going to draw a line down here on the seasonality for June 17th as well. Oh, come on, be nice. Okay, that's, let's grab this tool again. Let's get on the 17th. All right. And the reason I'm marking last week is because we've been doing these weekly trades. And I want us to kind of see what happened in the last week and kind of what the seasonality was. Okay, so let's come up to the top where that's our actual data. And we're seeing since we had our class, the SPX has essentially been going down. So the question is, well, is that normal for the seasonality? Well, over the last 5 years, it looks like maybe we would have gone up at least a little bit during that period of time if it did exactly what it did the last 5 years. But again, it's not guaranteed. All right, you want to know, can you see me? Oh, Carol's chatting with Jay Richardson. I'll leave that alone. Something that I experimented with today, and I found it interesting, so I'm going to share it with you. And that was, I said, what if we looked at a longer period of time of seasonality? The default here is 5 years, but what if we say looked at the last 20 years? Okay, 20 years might capture kind of modern trading history as opposed to going back even further than that. But that would at least be in this century, right? Say 2006 through 2026. So we're going to do that. What we're going to do, we're going to come up here and we're going to go to, well, I created a new time frame. What I created was a 20-year, 1-day time frame. And you do that by just coming over here, selecting on time frame, and then I just brought it to 20 years and kept it on day and created that. Okay, don't need to create that there again. But well, let's just say okay here. And then we are now on that 20-year, 1-day chart. Now our seasonality is down below. And you're like, that is kind of squished. It's making it a little hard for us to see. So we're going to come over here where the squiggle line is over here on the far right. Select on that, and then we're going to change it to manual. And then we're going to zoom in on the seasonality so that we can see it a little, well, quite a bit better. All right, so I'm just going to kind of zoom in here. That gives us a better idea rather, of the seasonality. Now, my nice little yellow line that I marked there isn't there anymore. So let's go put it in again on June 17th. All right, there's June 17th. And if we say, okay, what typically happens over the past 20 years, the seasonality is a little bit different, isn't it? It has more data in it, so it's more complete. It gives us a better sampling without maybe diluting the data. And it looks like between the 17th, and I'm going to put my mouse here on the 24th, which is just right there, looks like seasonality, typically it does go up a little bit. So just know that our last week did not go according to the seasonality of things. But here we are, we're in June 24th, and I want to look and see, well, what is coming up? What has the seasonality time frame been looking like as we get a little bit further into the year? So it looks like it kind of is a little bit choppy here, pulls back. And then this is June 30th, right here, this low point. And then we get a nice little run here, a nice bullish run, I should say. And it looks like seasonality over the last 20 years, it's peaked here about July 24th. Now, and then it kind of has a little bit of a pullback through the rest of the month getting into August. Okay, this date here is August 6th. Now, again, we don't know that that's what the market's going to do, but it's helpful, I think, in our psyche to know that this is what typically has been happening, okay? So when we're looking at the markets and where they are, what the seasonality is, I think that just helps give us an idea. So Jay Richardson says, so July is seasonally strong over the last 20 years. Yeah, it really has been strong. I'll change it back to 5 years here in a moment as well, and we can see what the, even just the 5 years, what it looks like. And if I recall, it's fairly bullish as well. So Charles says, why are we going back in the past 20 years? You're thinking that's too long. The reason we did that is so that we could get an idea of what seasonality has been in a more modern time frame, say about the last 20 years. 5 years is good. That's a good sampling of data. But 20 years gives us a little bit more data. But if I went back to 1929, sure, it would give us a pattern of all of that, but it encompasses so much data of previous periods that we might not necessarily be able to relate to in the sense that our markets have changed a lot and the components of our market have changed a lot. And so that's the reason for doing it. Now, George, that doesn't mean, or Charles, you do not have to do that, right? If you are more comfortable not going back that far, obviously you don't need to, right? You could use the 5-year pattern just fine. Let's see what else we have here. All right, I'm going to say looks like we've caught the questions here. All right, I said I'd switch this back to 5 years, which we'll do here. And we'll go 5-year one day, and then we'll get back to our pattern here. I'll just zoom in. And so it does look like here again, this is June 18th. This is June 24th today. And so it kind of looks like it has a little bit of a pattern of just some steady bullishness over the last 5 years. So if you're more comfortable with that 5-year period, you could do that. And you could do the same thing here where you kind of zoom in on it to maybe get a little bit more granular of a look. It still is a little bit more squished here. And so if you did want to do that, come change that to manual. And then I just typically come and go just under where the lowest point is and zoom in up to above where the highest point is. Okay, so if we're really trying to be a little bit more granular, here's the 24th. Okay, it looks like possibly some bullish activity if it holds true to patterns, but never guaranteed. Okay, all right, let's go take a look at a couple of trades we had going on. Now, last week, I told you that we were going to, as long as the rules provided that we could do some laddering in using our new rule structure, that we would do that, okay, that I would do that. So I'm going to pull up here. I'm going to just pull up this grid that I've added the index. Let's see. Got to take it out of seasonality mode now. Go back to our style. Oh, try it again. Go back to our style. Seasonality. Let's change it back to standard. All right, there we go. So now we've got our chart back up here. And what we talked about was incorporating, as part of a rule structure, some of the lines in the market forecast. Over here have been the index options strategy that we've been trading for the last, I'm going to say, in the neighborhood of a couple of years. Okay. And the big criteria to know if we would do a bullish trade on the SPX, because yes, the long-term trend of the SPX is very bullish, was just that it was above its 200-day moving average. Okay. However, we're going to go through some periods of time when maybe the SPX is not racing up, that maybe we're having a little bit of a pullback pattern. In fact, it looks like, I don't remember if I did this last week or not, but it looks like possibly it might be trying to form a little bit of a reversal pattern of maybe a shoulder, a head, and possibly forming another shoulder. Okay, so head and shoulders pattern, which is a reversal pattern. And even though we might see a head and shoulders pattern, it doesn't mean the market absolutely positively has to reverse, okay? We would want to see, let's do this, maybe drawing a neckline here where the bottom was here, just kind of drawing it along there. And then typically what we would do is we'd say, okay, if it breaks through the neckline, then yeah, then that reversal pattern looks to be starting to play out. Okay, is what we would do with that. And then we'd measure from the top of the head down to the neckline to see how big of a drop, a measured move that we might expect out of it. Okay, so could that be going on? We'll have to see. We'll have to see if it really, breaks through the neckline here. And I think probably the first warning sign would be if it's kind of, that line's a little high. I wanted to kind of grab that shadow of that tail. And now that looks like a nice fan there. In any case, we'd want to see it break down through the most recent support area, the most recent bounce. And then if it did, yeah, then it might be trying to break through that neckline. Okay, so we'll see. We'll see what happens there. All right. So we wanted to do some fine tuning of rules. And so we had said last week, I said, all right, if, and I'm going to go back and just look at my rules here. I said, if the SPX is above the 20-day moving average and it's above the 50-day moving average, and if our blue line down here in the market forecast is headed up, or if it is really close to the bottom of the reversal zone, which is 0, if it's really close to that and looking like, hey, it might just pop up on us, then we would allow ourselves to get into the trade. All right. So here was let's see. So here was last week, the 17th. Oops. Let me get out of my draw mode here. Get rid of that little guy. Come on. Oh, darn, it's stuck. Interesting. It does not want to get rid of it. Okay, we're going to be stuck with that line there. Sorry about that. Let me close out my drawing tool and then that should erase it. Got something a little quirky going on, almost like I have an error message that is not allowing me to acknowledge this. Okay, we might just have to put up with the yellow. Sorry, I'm glad I got some of it cleaned up first. All right, so here was last week. So on Friday, looked like it was above the 20, looked like it was above the 50. It was clearly above the 200, okay. And on our blue lines, let's zoom in here. So on this day, the blue line was just barely edging up. Okay, just barely. So we went ahead and we did put on a trade for 14 days out from last Thursday. All right, but on Friday, it wasn't above the 20. On Monday, it wasn't above the 20. And we wanted to have both of those conditions met, above the 20 and the 50 and the 200. But since it wasn't, we did not put on any trades Monday, Tuesday, and again today. Now let's see if the market closed below this 50-day moving average. 50 days at 73.48. It closed at 73.43. So by 5 points, it's closing below the 50-period moving average. So by definition of our new rules, where we're trying to be a little bit more picky, we would say it doesn't qualify for an entry here today. Okay. So just kind of keep that in mind as we look at this. We could still do a trade if we wanted to, but it doesn't qualify for the new rules we're testing out. And if any of you did do a little bit of back testing and you want to share your information about what you learned, feel free to chime in here, okay? Just making sure I'm catching all the questions here. I think mainly we just have some friendly. Mighty Quinn, did you get your question answered about the red and the green and the blue lines or not? Let's do it. Yeah, remind you of the time frames that we're looking at here a little bit more specifically, okay? And let's kind of maybe pull this up, and I'm going to maybe zoom out a little bit. This green line in our market forecast line is a representation of the intermediate trend, okay? Intermediate trend typically goes from weeks to months, okay? The blue line is a much shorter time frame. on this green line, it could take 4 to 6 weeks for it to go from, say, the upper reversal zone to the lower reversal zone. Okay, so it's not super reactive. It's an accumulation over time. This blue line, it can go from one reversal zone to the next in a matter of kind of like it's about 5 to 8 days, maybe up to 10 days. So we could maybe say 5 to 10 days out. Well, what does that correspond with? That kind of is a swing trading time frame, right? Where a swing trader maybe is just looking for a swing of momentum for a certain period of time. And so that near-term line is what kind of, would be maybe probably appealing to swing traders. And then this red line, super fast. It can go from one reversal zone to the other in 1 to 2 days. Sometimes it takes a little longer than that, but it swings a lot. And so we can see as we're looking in here, yeah, we see the red swinging all over the place. And you could even just do the red swinging while the green line is gently up in the upper reversal zone and very casually comes out of the upper reversal zone. And that red line has been swinging around several time frames. So if somebody were saying, I'm just doing some very short-term momentum trading, then that red line might be a little bit more representative of their time frame that they're looking at. Okay, so hopefully that does answer that question. Let me get back down here. All right. Let's see. Okay, you were okay. So asking about the testing. So Mighty Quinn says, yes, thank you. I was testing with both, but going to focus my time on the blue line. And that's kind of the conclusion I was trying to help you draw, is that blue line is more representative of our 14 to 7 day option trading on the SPX and our weekly trade that we do. And so that's why I wanted to kind of bring us into a little bit tighter time frames. So let's talk here for a minute about some additional rules. Okay, this is going to be on our entry. So on our entry, so I'm going to call this new index options. Okay, and it's still for a 14 to 7 day DTE strategy. Now I'm stuck on the caps. There we go. And so instead of just being above the SPX, above the 200, we're also going to say it has to be above the 20. It has to be above the 50. And so I'm going to maybe just put something here that's like entry. Okay. And it's got to be greater than the 200, 50, and 20 SMAs. Okay. Every line, it's going to be an and condition, not an or condition. Okay. And then what we had been experimenting with is the blue line from the market forecast. And on the market forecast, we were saying, I'm just going to abbreviate it like that, MFC. On the market forecast, we were saying that we want the blue line to be either in the upper reversal zone, so up here in this red, or rising, going up, or at the very bottom and looking like it might be bouncing up. Now today, if we take the measurement of the blue line, it's at 7.53 and falling. So it could fall for a couple more days before it actually gets, say, down to 0 if it goes that low. But one thing that I noticed here is that, and I'm going to go back a year here, kind of zoom out. Let's do this instead. And what I was looking at is I was saying, okay, in the last year, how often has that blue line really gone into the lower reversal zone? Yes, we've had quite a bullish pattern through here. So did it actually get down there very much? And so here was one on August 1st that it got down in the lower reversal zone. But you can see we go for a long period of time and it doesn't go down there again until, I think this day it finally did. That number is 13. And I lied to you. I looked at the wrong number here. This one was 11.8. All right, so this one is a little, let's see, get on the right date. And that blue writing on the black is really hard on my eyes. That looks like 13, 18. It's one of those numbers, 13 or 18. I haven't done my eye test yet. And then this one is about 17. And so as we go along here, it's like, yeah, it doesn't pierce down below that lower reversal zone very often. Okay, so if it were to, and we don't really see, I'd say maybe the lowest one, let's zoom in here. Maybe the lowest one is about right here, and it got down to 3.35. Okay, so then we could also say, okay, if it is below 5, okay, I'm throwing this out to you. If it's below 5, then it really doesn't have a lot more room to drop before theoretically it should pop up. Not guaranteed to pop up because there have been times we can see where it's gone sideways, right? And doesn't necessarily point straight up just because it's that low. Okay. Gary's making a comment here. Gary says, you know, it's a good time maybe to step aside. The market's been a little bit on the choppy side, and you don't have to trade in a difficult market, which I would agree. If you're uncomfortable doing that, or maybe don't have some good bearish rules, then yeah, you might not want to participate in a market you're not as comfortable with. Okay, so I would agree with you there. Oh, okay. Ram says, hey, this is the first time I'm hearing of index option strategies. Can you provide a link to earlier classes or suggest keywords to find related content? Absolutely. In fact, let's show that to you right now, because there could be some others in that boat as well. And I am kind of building on previous discussions. If you become a subscriber to our Trader Talks channel, it makes finding this information a lot easier. Okay. When you're a subscriber, this is kind of the look that you get. And here we are on our channel. And what you would do is you'd come over here to playlists. And then it's going to be down here. I think last week was down about 8 rows. And short verticals, trading index options. Where did it go? As new classes come on, it gets pushed down a little bit lower and a little bit lower. So I'm just looking. That's a different one. That's a different one. Where did it go? Well, let's do this instead. Let's just type in index options. And then we can see what there is for index options. And here's the class link, that trading index options right there. Okay. And you can go into that playlist and then you can see the layout. This is kind of showing me live here, but it should show you the different lineup. That link might not be best. Cameron, I'll have you do this. Cameron has posted the playlist in the chat there. And so I just clicked on it and I'm going to drag it over here. And here you do see the different lineup here of the previous sessions that we've been working on. And so Ben Watson taught this class for like the last couple of years and had a specific trading strategy of 14 to 20, 7 to 14 day options. Would get in at 14 days, and without fail, come class time, that would be 7 days left, we would close out the trade and put on a new one. And just typically we might call that a rolling, where we close down one trade, open up another. And so it's a continuous cycle of every single week putting on a new trade. And like I said previously, the rules were just that the SPX had to be above the 200 in order to take that rule. And now we're saying, okay, maybe let's use some shorter time frames, since the trade really is only a 1 week trade that we're dealing with here. Okay, so that's where we're going with our experimentation. And here's that watch list. Thank you, Cameron, for showing us that. And again, if you're a subscriber, it makes it a lot easier for us or for you to find that content up here under the playlist. But note that the playlists tend to rotate. Here it is. It's now on the second row. All right, so there's our trading index options if you didn't have the link to it. All right, let's get back to the rules here. So as far as an entry, we're going to say that today we don't have one either. Okay, however, where is that blue line today as we're coming into the close? Market's not quite closed yet. And that line is at 6.63. Okay. If it were below 5, then what we could add is a rule of saying, okay, if it's above these, the 20 and the 50 and that blue line, even though it's headed down, if it's down below 5, that means it's probably likely to pop back up in the next few days. Then we could experiment with that and see if that's too aggressive of a rule or if it's okay, right? We'd do some forward testing with it to see if that's the case. All right, so market forecast above 20 or 250 and 20, and market forecast line blue is up in upper reversal zone or below 5. Okay, and the reason below 5 is because then it's likely to pop up. If it's in at 10, it could still go down for a couple days, right? Versus being on the verge of popping up and knowing the blue line does not go that low very often. Okay, let's do one additional thing here. We have been getting out on an exit rule that is just based on time for class. We're going to shut down the trade, whether we're up on the trade or down on the trade, we're shutting the trade down, we're rolling it for the next week. And when you're looking at something that has really strong trend lines or trends, they don't have to be lines, and you look at something, say, like the SPX, that just has, for the most part, a steady trend up, that's why we kind of want to try to be in the trade as frequently as we can, right? Because that uptrend is so strong. It's not as susceptible to, say, one stock throwing things off, right? Because we've got 500 stocks in there. So it's a pretty diversified group that's moving forward there. So what if we experimented with this? I wrote down some exit rules that I'd like to experiment with. And that is, if we are in a bullish trade, and it's not time for a class yet, and if the SPX closes below the 20 and below the 50, and if the blue line is headed down, then we can get out. And more likely than not, if that blue line is headed down, the green line will be headed down as well. But we're going to just right now focus on the blue line, okay? If we were to add in those additional rules, it could be by the end of the day, trading day isn't over yet, but it could be by the end of the day that this really does close below there. And that blue line isn't quite as low as maybe we'd look for a pop-up if we were doing an entry. But just on the exit, below the 20, below the 50, blue line headed down, okay? We are going to experiment with that over the next week. Now, if I have an opportunity following these new rules for the entry, then I'm going to go ahead and get in. The idea here is that we were trying to ladder in, not just do a trade on our Wednesday, but if the setup's there on Thursday, great. We're going to do another trade for Thursday, 14 days out. If the signal's there on Friday, great. We're going to put on another trade for 14 days out, following and using our probability of expiring cone. And what we do here is we have this probability cone that gives us an idea of where the index is likely to be. This represents one standard deviation. So about 68% of the data points are likely to fall in this range. Doesn't mean they absolutely will, but they're likely to. Okay. And so what we do here, we come out, we get our drawing tool of our vertical line here. And what would be 2 weeks from today? Today's the 24th, so then that would go to July 1st, and then that should be July 8th. Okay. July 8th would be 2 weeks out. And so we would typically, there's July 9th, there's July 8th. Here's our July 8th. And put that line there. And then theoretically, we would say we're going to sell a put spread. And we don't know, but we would want it to be outside of our probability cone because that's the likelihood of where it's not going to be. And we want to sell there, right? We don't want to sell in here where the index is likely to be because we would like it to expire out of the money, right? So that's why we would use that as a little guide. So if we tomorrow, if it meets our rules, I'm going to come in here. I'll probably just move this line over to tomorrow's date, get an idea where's it, where does it fall on the probability cone? What's below that? What strike prices correspond there? And then sell a put spread. Okay. I'm hopeful, although I don't know that the market will recover, but I'm hopeful it will so that we can do our experiment we've wanted to do. And I will just update these rules real quickly. And I'm just going to kind of do a copy and paste. And I'm going to say we can exit in our class, or we can exit early. And let me bold this and make it white. Gray is not very easy to see here. Let's make it out white. And we're going to be very systematic with this. We're not going to trade it regardless. We're going to make sure it meets our rules for that time frame that we're trying to trade. Does that make sense to everybody? Any questions on potentially using some new exit rules here? So we kind of fine-tune the entry rules, and we're going to experiment with getting out early if the SPX is below the 20 and the 50, and if our blue market forecast line is headed down. Okay, that's going to be our exit rules. And so I'm going to, hopefully we'll get to do some laddering in here. If SPX closes below the 50 tonight, then we won't be able to do that until it has a close above the 50, which would take us into tomorrow. All right. If you want to paper trade these rules with me, do so. I love it when you guys do, and then you have some insight on it. Like somebody said, yeah, I was doing the green line, but I think the blue line's the one I really should follow. All right. Well, you guys have been great. We're going to have, this is kind of a little bit more of a more advanced class using these index options. However, coming up next is going to be Scott Thompson with more of a beginner level class. Okay. And some of you, I know, even though you're veterans of the classes and do some more difficult things, you're picking up some great things in Scott's class. I'm trying to remember the exact name of it. Getting started with trading, or something close to that. Stock investing for beginners. That's really what it is, the real name is. Stock investing for beginners. All right, you guys. Cameron, thank you so much for your help here today, answering our questions. And thanks to each one of you. We'll be kind of being active with it this week. We'll see what happens when we get together next week. We'll see you then. Bye-bye.